Good morning, everybody. We have an important announcement. Gary Black, about 4 hours ago, in the middle of the night, I don't know what he was doing up that late, tweeted this tweet. Tesla catalyst for February 15th, 2023. And he goes through all of this, but the bottom line here I want you to pay attention to is that $370 target price for the next 6 to 12 months. $370. Now, obviously, he's talking about Investor Day, the EV credit, the deliveries, the FSD, the mega pack, the buyback that hasn't been confirmed yet, and I don't think it's happening. The Twitter CEO announcement, the Cybertruck, which is also questionable when, the compact car, which has not been announced yet. There's a lot of wishful thinking here. There's a lot of good information here, good catalyst here, but this is just an estimate. So $370. Currently, the share price is about $209, $210. For the past month, the Tesla Q have not had a good month. Let's put it this way. You know how they say about basketball shooters? Well, he didn't have a good day. I think Tesla Q did not have a good career. Anyway, so the question is, how legitimate is this price? Can we do anything with it? $370 based on Gary Black. Can we stress test this? And I would say, yes, we can, and we will. So let's do it right now. Let's check how much this is true. Let's do a shit or legit test on Gary Black's $370 target price. So the first thing we want to take a look at, obviously we will use stock MVP for this. Now, the first thing we want to use is actually look at what other analysts are saying. I just want to remind you, Gary Black is saying $370. This is the stock MVP analyst chart. It aggregates all the analysts that are basically covering Tesla just to show you the different target prices. You have the low target price, $126 right here. You have the high target price, $526 right here. But mainly what's important is that you have the average analyst target price here, which is $327. So Gary Black is above that, but not miles above it. Obviously, they all give it A+, 5 out of 5, strong buy, etc., etc. But the average analyst target price here is $327, which is very close to Gary. Gary is above it, but I mean, it's not out of the realm of the current coverage of analysts. But then again, analysts in general is just one thing to look at. They get it wrong a lot. As somebody who got it wrong a lot myself, Palantir. I'm just kidding. I love Palantir. I mean, it's just one thing to look at. Now, let's move on to a little bit more of a, I would say, objective data here. Let's take a look at this thing here. So this thing here, before we will run the full DCF, we will run the full evaluation model. I'll tell you my target price in a second. I will, I promise. But the first thing, you have to understand what's under the hood of the company. You have to understand the fundamentals of the company. That's really important. And also it's important because that's the one thing I don't like about, I guess, other tools I used to use in the past, is you look at fundamentals, you can't see the history. It really, it's a struggle to go back and look what the trend is. Now, on Stock MVP, we built it so we can actually see the history. So, for example, revenues for Tesla is $81.5 billion. But if you look at revenues just 5 years ago, they were $12 billion. So clearly you can see the trend here, right? From 12 billion to 81 billion in 5 years. It's 600% up and actually listed here. So you can see that the revenues are more than impressive. The growth for the past year was 51%. That's important. Remember that number, 51%. The growth number is going to be a huge element of our valuation, not the sole element, but a huge element. Now, selling and general expenses. Basically, this is what I call the fat. This is usually where you can trim the most cost if you really were adamant about it. Now, as revenues grew 600% over the past 5 years, SG&A grew about 60% over the past 5 years. So you can see here that this company is generating 600% more sales with only 60% growth in SG&A. In fact, their SG&A have dropped 12.5%. The cost dropped over the past year when they grew 50% sales by 12%. Again, these are really impressive numbers. Now, on the operating expenses side, which is where you aggregate all the things that you have to do to generate these revenues, including SG&A, by the way, it's up 1.2% over the past year. So let me just be clear. So Tesla increased operating expenses by 1.2% and increased sales by 51.35%. I mean, you can't find a lot of companies that can give you numbers like that. Over the past 5 years, again, OPEX is up, operating expenses are up 86%. Versus a 600% increase in revenue. I think the efficiency question here is answered. It's an extremely efficient company with video game level numbers. I mean, this is insane. This is like playing Railroad Tycoon on easy mode. Now, one important thing here is looking at the increase in EBITDA. Increase in EBITDA is super important for our DCF. Coming up in a second, we have a DCF calculator here on Stock MVP, which we'll use in just a second. So EBITDA is at $17.5 billion, which is in itself something that's about to make my brain explode. I mean, 17 billion in EBITDA. And by the way, EBITDA is pretty much how much the company is making before the accountant assholes start finagling the numbers. So EBITDA is where I think it's the most important part. But net income is also important. Basically, EBITDA grew 85% of the past year. So 85% EBITDA growth is where we at. Now, in DCF, we'll use that number. We actually bring it down a little bit to be more conservative. Now, look at these. This is video game numbers. EBITDA growth over the past 5 years is 10,000%. So people talk about Tesla as a meme stock, as a hype stock, retail stock. My guy, if you're hating on Tesla, it's a 10,000% increase in EBITDA over the past 5 years. I mean, that's video game numbers. So $17.5 billion of EBITDA. Net income is $12.6 billion. Again, 660% net income increase over the past 5 years. That's insane. With OPEX up only 86%. So imagine increasing operating expenses by 80% and then increasing net income, which is the absolute bottom line, by 660%. Absolutely insane. Capital expenditures are not small for a company like Tesla. Mind you, the supercharger network is a super capital intensive business. So $7 billion, it's a lot of capex, but it's going to building that moat. By the way, the White House is all gung-ho about eliminating that mode and having Tesla open it up for the public. But guess what? That's what Tesla actually wants, because it's going to generate Tesla a lot more money. But that's a whole different video. So basically, we have CapEx here at $7.2 billion. Growth over the past year is 10%. So we're going to use that 10% again. CapEx growth, you remember that number 10%? We're going to use it for our DCF. Free cash flow, oh my goodness, $7.6 billion. 117% increase in free cash flow the past year. 282% increase in free cash flow over the past 5 years. You're starting to see the trend here. This is a very impressive company financially from a fundamental standpoint, not of a hype, not of a price action. Cash is $16.3 billion. Again, super impressive here. Total debt, it says here $3 billion, but let's say 3. Screw it, let's say 3. Although we can argue about that. 3, basically more than 4 times more cash than debt. They can literally repay the debt right now, be with 0 debt and $13 billion in cash. So this is pretty much, this is a wash. Liabilities is $37 billion, assets $82 billion. So double, literally double than assets than liabilities. I mean, this is absolutely insane. Okay, so the next thing we have to do is run a proper DCF, discounted cash flow valuation of Tesla based on its current numbers. Now, we have here on Stock MVP a DCF calculator, so you don't have to basically screw around with an Excel spreadsheet and break your fingers trying to figure out how to do it. Everything is here. In fact, you can automate the whole process just by clicking populate and calculate. You can also manually change all of these things, but basically in this example, we'll just use the auto-populate feature. So as you saw earlier, EBITDA growth, may I remind you, was way, way higher than 10%. Let's go back to the cards and let's see. So in the cards, EBITDA growth was 85% year over year, 85%. So in our example, we'll just use 50%. Let's just use 50%, which is way below 85%, just to be cautious. Now, CapEx growth was 10%. Let's keep it 10%. Depreciation and amortization, we can also do 10%. And we're going to do populate. And then we do long-term growth rate 4%, discount rate 10%, calculate. Now we scroll up and we find out what's going on. So basically, the DCF valuation we just got was $447 for this company. $447, which means it's undervalued by 113% and 81 cents. Now, we can actually make this a little bit tougher. You can do sensitivity analysis on these DCF models we have on Stock MVP, and you can do 12% discount rate, which means the stock will be cheaper. Basically, let's say interest rates are going up, so you want to have a higher discount rate to reflect more risk. Fine. Calculate. Okay, now we're getting $323. Basically, the exact number all the analysts are getting. So now we know where the majority of the analysts are. The majority of the analysts are basically saying, hey, this is a 50% growth rate on EBITDA and basically at 12% discount rate, 4% perpetual rate. So this is why if you go back to analysts, then you'll see that on the analyst side, 327, we just got what? We just got 323. So now you know that the analysts are basically here. That's why this is the average price, because this is what Tesla is actually worth. Now, Gary Black is saying 370, which means he either bets on the discount rate will be lower because of lower interest rates, or he thinks that the growth rate is going to be higher. So we can do that. We can leave 12% and we can put 60% in EBITDA growth rate, which is still below what they're actually growing at, and then you get $450. So Gary Black is probably in that area as well. Now, beyond the DCF, you want to have another kind of built-in suspender system. This is another tool we have called the SCFCEF tool. You can actually evaluate the stock here by a multitude of elements. As you can see, they're on the screen right here. I've already populated it. Basically, it has conservative valuations, optimistic valuations, and current valuation. And then you get the 5-year target price, and you get the bear case, the medium case, and the optimistic case. I've already populated it here on the screen. You can see revenue growth. Everything is actually on the conservative side below the current numbers. On the optimistic side, it's right about the current numbers, give or take. So this is what we get. And I actually did this just a second ago. I don't want you to be waiting for me to fill this out. It's on the screen. You can pause it and look at it in a second. Basically, what I'm getting is for the 5-year conservative, which means way below the current numbers, $400 per share, which is an 89%, 90% upside for 5 years at the bear case. At the medium case, $809. At the optimistic case, $1,200, which is an 840% on the upside. Now, look, these are insane numbers. And you might say, well, Tom, this is super expensive. I mean, how can you say $1,200? So look, Peter Lynch talked about it multiple times. Great companies, you probably have like 20 years to buy into them and still make a hell of a lot of money. I'm not saying 480%, but I'm saying like if Tesla is a generational company and they're actually going to do what Gary Black says, at least half the stuff he's saying here, they're worth $300, no doubt about it. I think Gary Black is definitely, based on our little test here on Stock MVP, has a good point. And to acknowledge the fact that we just had the first time in history GAAP profitability by Palantir yesterday, I'm willing to give you a 50% for life on Stock MVP. Use the code PLTR50. PLTR50, get a 50% off to use Stock MVP. If you don't like it for any reason, let me know. I'll refund you, no problem. I love that software that much. Check it out. As always, thank you so much. See you in the next video.